So imagine you have two identical market signals flashing at like the exact same time.
Right, but one is on a major U.S. index and the other is a Forex pair.
Exactly. And they're dictating completely opposite trades. It's fascinating. So welcome to the deep dive. Today we're decoding the Alpha preliminary morning brief for April 28th, 2026.
Yeah, we're isolating three specific asset zones today. The goal here is to really give you that early market context so you can map out your boundaries, before the final data drop.
Right, getting a head start. So let's kick things off with the Dow. The brief outlines a really clear sell action if we see a reversal back into this tight range, starting around 49,025.8 and going up to 49,357.2.
Yeah, it's a very specific zone.
It is. It reminds me of like stepping back inside a house you just tried to leave. Once you're back inside that doorway, you're stuck in that space.
That's actually a great analogy, and mechanically that recoil happens because of liquidity.
Okay, how so?
Well, when the Dow pushes out of a range and fails to hold it, it basically creates a trap for late buyers. So once it reverses back into that 49,000 zone, those trapped buyers are forced to liquidate.
Which just aggressively accelerates the sell-off, right?
Exactly. That liquidity vacuum is the actual mechanism driving the sell signal.
But wait, surely like a quick spike or some algo hunting for stops could trigger that, right? I look at the invalidation point, sustaining above 49,357.2 or below 49,025.8 as a hard stop. But how do you avoid getting faked out?
Well, you avoid it by requiring sustained acceptance.
Sustained acceptance.
Right. A quick flash through the boundary just doesn't count. The market has to actually prove it can hold and trade steadily outside those bounds.
Got it. So that sustained acceptance is basically your structural wall.
Precisely. It's the exact moment the market proves the setup wrong.
Okay, so while the Dow is flashing that really aggressive sell recoil, the S&P 500 is in a totally different state. The brief literally just says, wait.
Yeah, it's trapped.
Right, it's in this inter-range rotation between 7,140.1 and 7,178.6. So I guess without sustained acceptance outside those bounds, trading the middle is just asking for trouble.
Oh, absolutely. You don't trade the noise. The S&P just hasn't trapped enough liquidity on either side to force a directional move yet.
So you just have to sit on your hands.
Yeah, until it breaks and sustains outside that tight, 40-ish point window, patience is really your only structural advantage.
Which is wild because while the S&P is in that holding pattern, we're seeing the exact same failed breakout setup from the Dow playing out in a totally different arena.
The dollar-yen.
Exactly, the dollar-yen. But here, the action is a buy.
Right, so the dollar-yen setup hinges on a reversal back into the 159.09 to 159.59 range.
And the invalidation rule is the same, right?
Yeah. Sustained acceptance outside those bounds, it remains exactly the same as the equity side. We're just looking at sellers getting trapped this time instead of buyers.
Oh, so when the short sellers are forced to cover, the buy-side liquidity just surges.
You got it. It really highlights how universal these mechanics are.
Yeah, I mean, a liquidity trap is a liquidity trap, whether it's U.S. industrials or a major Forex pair.
The psychology of a forced liquidation does not care what the ticker symbol is.
That is so true. Okay, so distilling this early playbook for you, you're looking to sell the Dow on a reversal into its range, wait out the chop on the S&P 500, and buy the dollar-yen on its own range reversal.
But please keep in mind this is strictly preliminary context. The market is dynamic.
Right, you have to verify this.
Exactly. Watch the full podcast at 08.55 NY to prep, and then you must validate with the final 09.0 AM report at alpharoute.vercel.app. Don't execute anything before that.
Treat this brief as your early radar. And, as you prep your charts, think about this. If the Dow and the S&P 500 are flashing such remarkably different signals right now, where one is a clear sell and the other is just trapped, waiting, what does that underlying tension tell you about the broader, maybe conflicted market sentiment heading into the open?